Hi, this is Tim Dial with Nexa Mortgage, and just wanted to put this short presentation together to go over cash out refinancing and the advantages of it and kind of what it'll do for people. One of the reasons I'm putting this together is because we now have a program that allows us to go to 90% on conventional loans for a cash out refinance. Normally, they're like every other lender in the country for the most part can only go to 80%, but because we are the largest broker, we have a partner now that will go to 90% on conventional. Additionally, you can always go to 100% if you're VA, and if you're going to go to a VA loan, or if you already have a VA loan, whichever the situation is, you can always go to 100% on a VA loan, which is awesome. But for those customers who are currently in an FHA or a conventional loan or something like that, and they want to pull cash out of their property, now we have a 90% conventional program, and it doesn't have mortgage insurance on it. So it's a really awesome program for those who would like to refinance from an FHA or something that has mortgage insurance, but they're wanting to pull cash out to maybe pay off some debts or something like that. It's a wonderful program for that. So I'm going to go ahead and I'm going to share my screen here so that I can go over some things here. This is a slideshow that I have put together to demonstrate this. As you can see here, 90% to 100% cash out refinance. The 90% is for conventional, 100% for the VA loans. So that's what the program is. Additionally, if you currently, like I said, if you have a FHA loan and you currently have mortgage insurance on it because they don't let you remove it, then you could refinance to a conventional loan, pull cash out to pay off high interest credit cards and things like that, and then put yourself in a much better financial situation by reducing how much you're paying out each month. So let's go on to the next slide here. So there are different reasons why people take cash out of your home. One is for debt consolidation. This is by far the most common reason people do a cash out loan. They have high interest credit cards, they have car payments, they have all these different things they're paying on. They take cash out of their house and out of their equity, and then they pay all those other things off, and they're left with just a mortgage payment. And cash flow, a lot of times cash flow is $1,000 to $2,000 better once they do all of that, and it just puts them in a much better financial situation to just have that one mortgage payment and not have all these other things they're paying on. So that's the most common reason. As you see here, it says get rid of high credit card debt, significantly lower your total monthly payments, improve your cash flow. Skip 2 monthly payments when you refinance, allowing you to save thousands in your bank account instantly. So the way that works is, let's say you're paying your mortgage right now. We close your cash out refinance in, let's say we close your cash out refinance in the beginning of December, for instance. Just use that as an example. Well, if we did that, you wouldn't have to make your December payment on your old mortgage. Your new payment wouldn't be due. You always skip a month, so your new payment wouldn't be due until February. So you could skip December, you could skip January, first payment due February. And that's what I mean by skipping 2 monthly payments. If your mortgage payment's $3,000 a month, that's going to save you an extra $6,000 in your bank account, in addition to the monthly savings you're going to get from paying off all that high interest debt. So it's an incredible thing to do with your equity in order to put yourself in a better situation. Second reason is people want to do home improvements. So you pull up some money out of your home, use it for upgrades for things like new kitchen counters, new floors, things like that. You could also put like I did. I pulled cash out of my home, and we built a really beautiful large sunroom that we love. We spend all our time in there now. We've put a hot tub in there. It's a wonderful entertainment space for us now that we put that addition on. That addition also increased our value by about $100,000 because of the extra square footage, because it is fully air conditioned and heated. So you could do additions, or the other thing you could do is needed repairs. If you have some things that are failing in your house and things like that, maybe your roof needs replaced, and because it's 30 years old or whatever, all sorts of different possibilities there. But you can pull cash out to make needed repairs to your home in order to keep it in a good repair situation. Other things people pull money out for, things like college tuition or emergency expenses. They have a really bad illness or something, they're in the hospital a lot and have all these medical bills they need to pay for, then they can pull cash out for that. Or for college tuition, instead of doing tons of student loans, they pull cash out, pay for college, and they don't have all that student loan debt, or they keep their child from having all that student loan debt later. So those are possibilities as well. And then of course, whoops, I went too quickly there, but investment opportunity is another reason. You can pull cash out. A lot of times investment property takes a 15% to 20% down payment. So you take money out for that down payment and buy something else, another property that's money making that you are obtaining rent on, maybe even multiple properties. Or you can also pull cash out because there's an investment opportunity. Maybe there's a company that you want to invest in that you think is going to take off as far as their stock price and stuff like that. You can do that, or you can take cash out to start a business or something, some sort of an investment opportunity like that. So there are lots of different things there that you could use it for. But the main thing we're concentrating on today is going to be the debt consolidation piece, because that's the part that, the other things are kind of self-explanatory. The debt consolidation piece, people don't necessarily understand completely. They're like, well, I currently have, a 3.5% interest rate. If the current rates are 7% or 6% or whatever, I don't want to go to that higher percentage. But if they're paying 22 to 29% on credit cards, which is normal right now, a lot of times the blended rate is much higher because of all that credit card debt and the way the credit cards get, and also the cash flow is a lot worse. People are paying a lot of money on these credit cards every month and paying a lot of interest on them, and it turns out their overall payment would be a lot lower if they just refinanced and put it all into one payment. So I'm going to go through that. That's the primary purpose for this. So if you look at the example scenario here, this is an up to 90%. You can consolidate debt with a cash out refinance up to 90% on a conventional loan. That's what I'm kind of covering here. If you were doing VA, the big difference would be VA's got a better upfront interest rate, so your payment would be lower on a VA loan. If you have the ability to do that, then that's great. That's the way to go. If you don't have the ability to do that, then this is the great alternative for any other type of financing. It is going to be good if your credit score is at least like a 680 or better. Cash out refinances below that are kind of difficult, especially going to 90%. So, credit score is important. But the other part of this is once you do the refinance, your credit scores are going to go up because of paying off all that credit card debt. So, anyway, this is assuming a value of a home at $475,000. That means that 90% of that you can refinance up to $427,500. Current mortgage balance on this scenario is $325,000. They currently have a 4% interest rate, and their total payment, including taxes and insurance, right now are $2,150. The new loan is going to be $425,000 because we don't need the full $427,000 to pay off all his debt, and so that's what we're going to go with here on this scenario. His debts include $35,000 on a car loan. He's paying $650 a month on it right now. His credit cards are $55,000, and borrower's paying about 5% of the balance of those credit cards on those credit cards each month to keep it from going up much, because he doesn't want that debt to explode any more than it already is. So he's trying to keep those payments from going too high, and keeping that debt from going too high. So currently that 5% balance, 5% of the balance each month that he's paying is $2,750 that he's paying on his credit cards. And the average rate on the credit cards, 22.5%. That's actually probably a little bit low for today, but I think when interest rates come back down, you're going to see that average be a little bit more common. And then so he's paying about $1,031 in interest every month on his credit cards right now. And then so anyway, his payment $2,750 on his credit card, $650 a month payment for his car payment, and then he's also paying the $2,150 a month for the mortgage that he's paying on right now. So let's say that on the new loan that we're doing, the interest rate is 7.99%, which is kind of high. There's a good chance you're going to get lower than that, but I wanted to go with a fairly high scenario here just to demonstrate that it still makes sense, right? So the new mortgage is going to be about $3,500, including taxes and insurance. And that's considering we're going to a new mortgage amount of $425 instead of the $325 balance. So we're going to pay off the car and all the credit cards and the old mortgage with that $425. It's going to pay all of that off, and that's going to add up to $5,550 per month that we're paying off. So that's what he's currently paying. If you add up the 2750, the 650, and the 2150, you're going to get 5550. So we're paying all that off, and so he's not going to have those payments anymore. So the borrower is saving $2,050 per month in cash flow because the new payment's $3,500 instead of $5,550. So it's $2,050 per month in cash flow, and like I said before, the credit scores are going to go up because he's got all that credit card debt paid off now. So that's how that works. And even though I'm saying, 680 credit score is kind of where you want to be, 680 or better. If you do have a lower score, it could still make sense. We can certainly take a look at it, see if we can get you approved for it. It's definitely possible. It's going to depend on many factors as far as debt ratio and stuff like that. But it could still make sense because your credit score is then going to go up, and you're going to want to refinance again later anyway. If you do this, if you do the cash out refinance at this 7.99%, once that credit score drop, or once that, not credit score, once the credit score goes up and the interest rate comes down, which we know is going to happen, then you're going to refinance again in order to save your monthly payment on the mortgage. And I'll demonstrate that a little bit later too. So anyway, the other part of this is the borrower is going to save $4,300 up front by skipping the two mortgage payments. This $2,150 times 2 is $4,300. So he's going to skip to two mortgage payments while he's waiting for this new mortgage to take effect. That's $4,300 he's saving in the bank there. So then the next part of that is within the next year, and it could be 2 years, but we're just for example purposes, we're saying year. Borrower refinances again at a rate of 5.5% interest next time, saving two mortgage payments again up front, which is $7,000 this time that he's going to save on the two mortgage payments, and lowering the payment to $2,800 from this $3,500. So going to be saving about $700 a month by dropping that rate from the 7.99 to 5.5. And it could be that the rate's even lower than that. You save even more when you refinance. I'm just using this as an example. So because everybody who's doing this right now is going to refinance within the next couple of years. So that's the thing to keep in mind. All right, so that's kind of what I wanted to get into with the scenario as far as up to 90% cash out on a conventional loan. I just wanted to cover briefly VA cash out and what the difference would be. So on a VA cash out, the rate would be about 1% lower on the front end because VA's got better interest rates. They don't charge you extra for doing a cash out loan like conventional does. Go to 90% conventional, you are going to pay a higher interest rate because you're doing a 90% conventional cash out, and they hit you on the rate for that. VA doesn't do that. They let you go all the way to 100% and don't charge you with any extra on the interest rate because you're pulling cash out. So VA, you would be at about 6.99% on the same scenario, and your payment would be about $300 lower initially on the VA loan. You could take cash out up to the full value of the home to $425,000. You may not need that much, but it does give people more flexibility if they need extra money for something. And then you would still want to refinance a year later, and the new rate would still be lower, but not quite as big a difference, because when you're refinancing it to a normal rate and term refinance, the conventional loan isn't going to hit you with a higher rate the next time. So the rate, instead of being 5.5%, if the conventional rate's 5.5%, the VA would be around 5%. It'd be about 0.5% better on average. So just using that. Timing of the second refinance in either scenario may depend on the values increasing and how much rates drop over the next 1 to 3 years. Just using a 1 year as a possible example, as we're expecting rates to be lower in late 2025, around a 50% to 75% chance of recession in 2025. And if that happens, rates will drop quickly and drastically. So a lot of people are estimating that mid to late year next year, we will see a recession take place. And if that happens, the Fed will be forced to really lower the rates quickly. And that's when you're going to see tons of people who need to refinance will be refinancing late in the year next year if that happens. So that's kind of what we're looking at. If that doesn't happen, then maybe within the next 2 years it'll happen, and we're going to see rates are going to drop anyway. It's just about how much and how quickly they drop. That 5.5 or 5 might actually be high if we have a recession. If we have a recession, you might see these rates go to 4% possibly within the next year. So it just depends on when the recession happens, how quickly, and things like that. But the rates are going to come down regardless. Like let's say your rate was 7.99 right, 7.99 right now. Within the next year, you're going to lower that rate by at least 1 to 1.5% without a recession. With a recession, it's going to go even lower. So that's a little bit about what I wanted to cover there. So that's pretty much it. I wanted to cover this stuff and not take a ton of time, cover it fairly quickly, as you can see what the benefits are, and using a real live scenario and how much money you can save. You saving $1,000 to $2,000 a month is what you can kind of figure if you're paying off high credit card debt. And it could depend on, I've had people who, instead of 50,000 credit card debt, they had 100,000 credit card debt. And so it just depends, but getting all that paid off, it's going to, really relieve a lot of stress. Your credit score goes up, and you don't have to worry about being able to pay your bills anymore because you just have this one payment now, and it's a huge factor. So if you want to get approved for it, the easiest way is to go to my loan application at timdial.com. As you can see here, timdial.com. Or if you have other questions or want to discuss things and discuss your own scenario, feel free to give me a call or send me a text. My number is 615-995-2615. I'm always here to help and to answer any questions, and I'm not going to apply any pressure if you're not ready to do something right now. I don't push for that. So that's pretty much it. If you have any questions or anything, I'm here to help, and feel free to reach out anytime. Thanks. Bye.